In trading, knowing the overbought and oversold zones helps us immensely in identifying reversals with ease. To do so, most of the traders use the RSI indicator. The problem with RSI is that it is a slow indicator. If you have traded the RSI, then you will surely know that RSI signals are sometimes very late and rare. So, what should we do to get faster and regular signals? The answer is using the stochastic indicator. In this video, I will be sharing a swing trading strategy based on the stochastic indicator that can help you capture short-term swings in the market. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. First, let us understand, what is the stochastic indicator? Stochastic indicator is a short-term momentum indicator that is very similar to the RSI indicator. The basic premise of the stochastic is that it compares the current close to the highest and the lowest closes during a particular time period. So, if we chose a 10-period stochastic, it will show where the current candle is in the range of the last 10 candles. So here is the stochastic indicator. On the Indicators tab, we have two lines. The blue line here is the %K line, and the orange line is the %D line. The blue line is the actual stochastic line. It shows us the actual value of the stochastic. The orange line is simply a 3-period moving average of the blue line. Some traders like to use the crossovers of these lines to determine entry and exit points in their strategy. We will cover these crossovers later in this video. Other than these two lines, we have also marked this zone in the middle of the indicator from the 80 level to 20 level. Just like the RSI, the stochastic indicator is also used to identify overbought and oversold zone. When the stochastic goes above the 80 level, it is regarded as an overbought area, and we expect the price to make a short-term down move. Similarly, when the stochastic goes below the 20 level, it is regarded as an oversold territory, and we expect a short-term up move. So, a great strategy would be to sell when the stochastic goes overbought, and buy when it turns oversold. No, while that strategy may sound good in theory, but in real life, the price does not obey the overbought-oversold conditions at all times. So sometimes, in a strong uptrend, the stochastic may remain overbought for extended periods without any downside move. Similarly, in a strong downtrend, the stochastic may remain oversold for a long period of time without any upside move. This is simply because the stochastic is a fast indicator. And always remember, fast indicators are vulnerable to false signals, while slow indicators are vulnerable to late signals. The main problem here is, how do we avoid false signals? The answer is pretty simple. Trade in the direction of the main trend. So if the price is in an uptrend, we will only be looking for buying opportunities. And these buying opportunities will occur when the stochastic goes below 20. In an uptrend, we will avoid the overbought signals at all times. Similarly, in a downtrend, we will look for selling opportunities when the stochastic goes overbought above 80. We will ignore oversold signals at all times in a downtrend. Now that we have understood the basic premise of our strategy, let's move on to the exact entry and exit rules. In a swing trading strategy, we are basically looking to capture short-term market swings that last for 3 to 5 days. We simply buy low and sell high in swing trading. Since this is a swing trading strategy, we will use the daily timeframe for our analysis. Our strategy mainly focuses on identifying short-term pullbacks in an existing trend and entering at the end of a pullback. In other words, it is a trend-following strategy that tries to enter the trend on pullbacks. To enter on pullbacks, we first need to identify the existing trend. To do so, we will use two moving averages. A moving average is a simple indicator that helps us in identifying the trend of the market. We will use a 21-period exponential moving average and a 50-period exponential moving average. On this chart, the yellow line is the 21-period EMA, and the red line is the 50-period EMA. Now, in an uptrend, we see that the 21 EMA is above the 50 EMA. And both the moving averages are sloped upwards. And in a downtrend, we see that the 21 EMA is below the 50 EMA. And the EMAs are sloped downwards. Another characteristic of a moving average is that they act as dynamic levels of support and resistance in trending markets. For instance, in an uptrend, we see that the area between the 21 and 50 EMA acts as support multiple times. Similarly, in a downtrend, we notice that the area between 21 and 50 EMA acts as a resistance multiple times. We will use this characteristic and combine it with the stochastic to enter and exit the markets. So let's look at the rules for buying and selling. First up, we have the rules for buying. For a buy setup, we want to see the price in an uptrend. In an uptrend, we want the 21 EMA to be above the 50 EMA, and we want both the EMAs to be sloped upwards. Then we wait for the price to pull back to the area between 21 EMA and 50 EMA. We will call this as the retracement zone. Once the price reaches this zone, we want the stochastic to be oversold at the same time. This will be a powerful signal. Let me explain. See, when the price pulls back to the retracement zone, we know that in an uptrend, the price may find support at the EMAs, and it may move upward. On the other hand, we also see that the stochastic is oversold. An oversold reading in an existing uptrend further confirms that the pullback may be over, and the price might be headed higher. So, we have a confirmation of EMAs and the stochastic that the pullback is over, and the price is ready to move. Now, all we need is a signal to enter and exit. For that, we will use the crossovers between the orange line and blue line. Remember, I told you that traders use these crossovers to generate buy and sell signals. When the blue line crosses above the orange line, it is a buy signal. We will call this as a bullish crossover. And when the blue line crosses below the orange line, it is a sell signal. We will call this as a bearish crossover. These signals are not powerful on their own. It is their positioning that matters the most. Therefore, if the bullish crossover occurs in the oversold region, then it is a powerful signal that the buyers have gained the upper hand and the price may advance. So, in our strategy, we want a bullish crossover at the oversold regions, and we want bearish crossovers at the overbought region. Back to the strategy in our buying setup, once the price is in the retracement zone, and we have an oversold on stochastic, we are looking for a bullish crossover. On this candle, we finally get a bullish crossover, and we shall buy at the close of the day. We will keep our stop loss below the entry candle, and we will keep a profit target at the risk-reward ratio of 1:1.5. If the price does not hit our target or stop loss in the next 3 candles, we will simply exit at the end of the 3rd candle. This is because our strategy is such that we expect a strong momentum after our entry. If we do not get that momentum within 2 to 3 candles, then most of the time our stop loss will get triggered. So it's better to exit anyway. Now let's look at an example. Look at this chart. On this chart, we can see that the price is trading above the 21 and 50 EMA. We can also see that the 21 EMA is trading above the 50 EMA. Both of the moving averages are also sloped upwards. So, we can clearly identify this as an uptrend. Now, in an uptrend, we want to look for buying opportunities. To buy, we will wait for the price to pull back to the area between the moving averages. On this candle, we see that the price touches the retracement zone. Once the price reaches the retracement zone, we will look at the stochastic. On the stochastic, we see that this candle also coincides with the stochastic being oversold. So we can clearly expect the price to move upwards from here on. But we will not simply buy yet. We will wait for the stochastic to create a bullish crossover for our entry. On this candle, we can clearly see that the blue line crosses above the orange line. This is a bullish crossover. This is a perfect trigger of our entry. So we will place a buy order above the high of this candle, and we will keep our stop loss below the low of this candle. We will keep our targets at 1:1.5 risk-reward ratio. And, as you can see, the price went on to create a series of green candles that eventually achieved our targets. So this trade turned out to be profitable. Now let's look at a sell trade. On the sell trade, we will just inverse the rules that we discussed in the buy trade. Here is an example. On this chart, we can clearly see that the price is trading below the moving averages. We can also see that the 21-period EMA is below the 50-period EMA. Both the EMAs are also sloped downwards. This clearly states that the price is in a downtrend. Now in downtrend we are looking at selling opportunities only. Our job here is to wait for the price to pull back to the retracement zone. On this candle, we can see that the price pulls back to the retracement zone. So according to the moving averages, we expect the price to find resistance at the moving averages and move lower. But we want to look at the stochastic to confirm this. On the stochastic we see that the value of stochastic is above 80 on this candle. This means that the stochastic is currently overbought, and we might expect a sell-off in the price. Now, all we have to do is wait for a bearish crossover on the stochastic. On this candle, we see that the stochastic gives us a sell signal. Hence, we will place a sell order below the low of this candle. We can keep our stop loss above the high of the candle, and we can place our targets at 1:1.5 risk-reward ratio. And as you can see, the price achieved our target with ease. So that brings us to the end of this video. In the end, I would highly suggest you to test out this strategy on your own and paper trade it for at least 3 to 6 months before investing your hard-earned money into it. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.